All right, Patrick, today's episode is all about CYA. What does that stand for?
Cover your buddy, cover your.
Now, we're talking risk mitigation today. I love it. We're going to speak about it from very different perspectives. We're going to speak about it. We're going to be kind of a case study. I mean, I recently went through a situation I've been dealing with for the last year where I really had to risk mitigate first. And in fact, I want to open up this whole thing by talking about risk mitigation because you and I have a very interesting view of real estate. And that is, it's more, for me anyways, I can speak to it, which is I look at real estate as really a risk mitigating strategy. The whole thing with real estate, when it works well, is that you're mitigating the risks. And I believe, my fundamental belief is that the real estate market will take care of you if you mitigate the risk. And it's more about, because real estate is a lot of like singles and doubles and singles and doubles and singles and doubles. And where people often go wrong is they swing for the fences, they don't risk mitigate, they miss, and they're out. Because really, when it comes down to it, Patrick, at the end of the day, real estate's like, it's a big game. You have a lot of money tied up into it. And if you swing for the fences and you miss, you can be out of the game, and that's not good for anybody.
When it feels scary to jump, that is exactly when you jump.
Well, when we go through boom cycles like we've gone through over the past couple of years, everybody looks like a real estate genius. And, if I've learned nothing over the years is that regardless of when you're making hay, there's a term, make hay while the sun shines. And when you're going through a boom cycle, that's where you want to actually make hay. Got it. But often what we're seeing, and we've seen many times over the years, is that people think this is going to last forever. So you use those times to make hay to actually hedge your bet, to kind of pad the bank accounts, if you will, because cash remains king. Because when the up cycle, everything's looking great, but in the down cycle, that's where things go off the rails. And if you don't have the cash to cover it, then of course you're in trouble. And that's what we're seeing time and again. I think about RAIN meetings back in September, October of 2022, JG, where I was literally telling people this is not the time to be over leveraged. I remember specific meetings time and again. I said, have you got access to capital? Have you got access to cash? If you don't have cash, you have access to a reasonable line of credit. This is not the time to not be liquid, given where we saw the economy shifting and changing. And, that's where the example of cover your ass came in, and the example that you've got on a property that you've got going on that we should talk about.
We definitely will. I'll touch on that property. It's called Whittington. I'll talk about Whittington in a few minutes. But Patrick, I think what's really important about this concept of cover your ass and this concept of risk mitigation is really, a lot of people think, especially when it comes to real estate, and we've seen this a lot. You and I have been speaking about this quite a bit in the last 12 months, 15 months, where people think to risk mitigate, they should not be in the game. Maybe let's speak about that a little bit, Patrick, because in our view, that there's some risk to not being in the game. And a lot of people think, listen, I'm gonna eliminate my risk by not being in the game. No. When it comes to real estate, if you're not, you can risk mitigate and be in the game, which is what you need to focus on. If you're not in the game, it could be riskier than anything else, if you know what I mean.
Well, how many times do we say get off the sidelines? There's no bad economy to invest in real estate. There's just the wrong strategy given what's happening in the economy. So many people have this whole strategy locked in. They go, it's got to be a buy and hold. It's got to be a fix and flip, whatever their strategy is. And that's okay. Well, if that strategy doesn't work, I can't be in the game called real estate and building that portfolio, which this is not true. Adjust your strategy to kind of accommodate the economic conditions. That's really what we're trying to say. Don't sit on the sidelines, look at the strategy, and then actually use what's happening in the economy to actually leverage real estate, leverage your capital to stay in the game. So that's, the overview of what that has to be.
Now let's talk about this example. I have this property I did 1 year ago. It was actually pretty much a year ago, bang on. We purchased this property called Whittington. We got a great price on it. We got a good entry price. And I was actually very excited about the property, and it has been a phenomenal property. First and foremost, the location. It's in Peterborough. It's just off the 115. It's really close to the college. It's like 2 blocks away from the college. It's on a huge plot of land. It's 90 feet wide by 300 feet deep. It's a beautiful, at the end of a cul-de-sac. I mean, phenomenal location, really nice bungalow that was very, very weathered. I mean, this thing was owned by an old Italian family, and they just used this property. They raised like 18 kids in this thing. I don't know, but it literally it needed a lot of love, and we definitely renovated it. Now the idea, and this is where some cover your ass strategies comes from. The idea was to flip it. The idea was we got in at a good entry price, and if we could renovate it, well, we'd be able to flip it and do quite well on it. Now, we ran into the first problem, which was there was more renovations needed than originally budgeted for. So the budget essentially almost doubled. So that presents a problem. Anytime you're going to double a renovation budget, Patrick, what that means is either the market has to be able to sustain that additional price, or you're going to have to hold on to this thing much longer. So what we did, and let me make it practical for people listening to this. One of the things we did when we were renovating it is we renovated with multiple exits in mind. We renovated it in such a way where it could sell to a single family owner. We renovated it where it could sell to someone who was interested in student rentals. We renovated it so it could sell to someone who was interested in creating an additional dwelling unit and a suite out of the basement, and then adding a coach home at the back. So we renovated with multiple exits, and we are now actually just recently put this property back on the market like a couple days ago. And we are again testing the market to see if the market's appreciated enough for us to get rid of it. If not, that's okay. We're going to rent it. We're going to hold on to it for another year, and we're going to sell it next summer. But the main tactic to covering your ass in my approach, Patrick, has always been to have multiple exits, at least 3 exit options. When you go into a property, you're figuring out a way, how am I going to get offload this thing 3 different ways, and that really helps mitigate the risk. That's one of my approaches.
You're a goddamn genius. That's the most outstanding answer I've ever heard.
Well, there's a couple things that I want to pick up on there. First off, I mean, you are very experienced in the business of renovations and real estate. So Vista Properties, you've done dozens of these kinds of things. Even you can get caught off guard in terms of a renovation. You went, okay, here's our budget. Oh, we just doubled our budget. So that can happen, number one, even to the most experienced individuals. Number two is that you're looking at your exit strategy and you're saying, okay, well, we can't exit the way we thought. We have to look at these other exit strategies. Let's test the market on something else. My point was, and when we talked briefly off camera, was this, is whether you were conscious of the decision-making process or not, in the back of your mind, you had breathing room. You got a whole other portfolio, you got a whole operating company. So you weren't scraping the bottom of the barrel or the bottom of the cash barrel. So in other words, at some level, you knew that you had room to maneuver. When we're working with real estate investors, and where we see the most common mistake made is they go all in on that deal. They got no cash left. They got no access to capital. Things changed in the marketplace. They get caught off guard. Oh, my renovation costs doubled. So now they're borrowing money to finish the renovation. And by the time they get it finished, now they can't exit because they only had one exit strategy, not a number of exit strategies. So that's all part of risk mitigation, hedging your bet, covering your however you want to cover it. But at the end of the day, you had breathing room. And that comes from understanding one fundamental in business. Cash is king. Don't stretch yourself out. Avoid it. That's the bottom line.
No, you're absolutely right, Patrick. The other thing too is, like, for this particular property, and this is how real estate investments, for those that are not quite as savvy, this is how real estate investments go off the rails really quickly, because this was actually 3 factors that hit us all at the same time. And let me go through them. The first one was, we figured we were at the bottom of the market, and we accurately assessed that. We were at the bottom of the market. We bought it for bare bones, and our entry price was good. Now, that's often a mistake, by the way, Patrick. Most people have an entry price that's not good. It's too high. And as a result, they don't give themselves that flexibility because they paid too much for the asset. In my case, that wasn't our problem. We actually got it at a very, very good price. We were happy with the price, low 500s for a 2,000 square foot bungalow, plus like 2,300 square foot bungalow on that size of property, and that location was a really good deal. and that property is no doubt, is worth 750, 800 all day long. That's for sure. So we were happy with the entry price and we often say it, Rain, you never know how long you're going to be in a cycle. You just know you're going to go from one part of the cycle to the next part of the cycle. So I knew we were at the bottom of the market. I didn't know how long we would stay there. And you and I both expected the Bank of Canada to lower their rates faster, which would get us out of the bottom of the market faster. That hasn't happened. They've been very sticky on those high rates for the last year. And now that the rates are starting to come down, I expect us to move past that part of the cycle in my particular market. So we just stayed there longer than I expected. I didn't think we would be there for 12 months. So we had to be prepared for that. The second thing is our renovation budget went up. As we started renovating, we got into a place where you take out a wall, you uncover this, you uncover that. And listen, at the end of the day, I want to sleep well at night. I'm not going to patch up any crap. I want to make sure that we have a good product. We have a very good reputation in this market, and my reputation is worth more than just a little bit of profit. So it's more important for us to do it right. So we went further than we had to, but we have a beautiful product now, and it's an absolutely incredible property. So the renovation budget hit us. And then the third and final thing is really, when it comes down to it, is luckily, and this helped us, the rental market continued to be very, very strong. So we ended up renting it in order to support itself for the last 12 months and be as cash flow negative as least as possible because of the strong rents. And those are the things that kind of factored into this this particular property. And now here we are, 12 months later, we've reassessed. Now we're making we're testing the market. We're tasting, we're testing, we're seeing where the market's at. And then we're going to make a new decision whether we hang on for another year or we don't. And yes, Patrick, you need to have the financial stability to be able to make these decisions. And that's not everyone's in that position.
100%. But, we go back to a couple things where we talk about these cycles, and where people make the mistakes is, for example, even if they, let's say they have 2 or 3 doors, they see the market shifting. And, to your point, months ago, we talked about this, you've always said, be really careful about student housing. And of course, we start to see that in some areas, student housing is very strong. And then you start to look at the shift of short-term rentals. Then you start to see Airbnb get shut down. And yet they've moved everything into that. So they're not risk mitigating in that regard as well. So when we look at these cycles that we go through, and to your point, is that we have to consider the possibilities in this going all in. It's like putting all your cash in on this particular deal, putting all of your momentum into this, and then all of a sudden things shift. So there's always this thought process that has to be going on, which is, how do I mitigate risk? What is the scenario what happens if? And these are conversations that aren't often had, or thought processes, because they're only looking at the money that's there and that they're seeing this. And you have to really give it some thought before you make those kind of business decisions.
Now, I'm going to take it one step further though, Patrick, because you and I are both now, let's call us mature investors. You're much more mature than I am, as in much older. Well, we're both mature investors. I've been at it for 20 years. You've been at it for like 40 years. But the point is this. I joke, but the point is this. Of course, it's easy for us to say that because we're a bit more mature. We've done more deals. You speak about Vischer's done, dozens of renovations. I mean, we have like almost 20. We got 24 renovations ongoing right now at the very same time. So it's like, we've done hundreds of renovations over the years, and we've definitely been able to build up where we can weather these kinds of storms. But let me connect this back to the person who's watching this and saying,
guys, this is great. I love what you're saying, but this is my first deal. So should I go all in or shouldn't I go all in?
And it's very important when you're first starting out in real estate, you have to choose those first 3 properties really, really wisely. And you and I have talked about this before, Patrick, where those first 3 properties, they got to be cash flow positive. They have to be in phenomenal locations. You cannot bet the farm or get risky on those first 3 properties. They got to be solid because they become the foundation to your entire empire. And if you get risky on those first 3, it's going to get harder and harder and harder for you. And I go back to when I started my real estate investing career, those first 3 properties, I still have those first 3 properties, and they are by far my best properties, my rocks, they are the cornerstone of my portfolio. And now I have the ability to play a little bit more. But if you're just starting out, you're going to have to go all in, Patrick, because most people on their first property, they got to go all in. Real estate's expensive. You got to put a lot of money into this thing, but you got to pick the right property, and you got to be fully risk mitigated. And that's where like the supportive rain really comes into play in terms of like, am I doing this right? Am I following the process?
Yeah, putting yourself in the right environment where you're getting support, where you're getting some guidance, that is absolutely crucial. I think that there's a lot of things going on with this market right now, and let's get into some of the things that are happening economically, JG, but it's throwing people off. So first and foremost, there's lots of deals to be had out there. I say lots, but they're not easy to find. You got to go out, you got to work with them, you got to have a great realtor, you got to have a great mortgage broker, investor focused, and you got to be patient looking for these deals. This isn't the time where you have to chase deals. This is a time to be patient, but to continue looking for that ideal property, especially if you're onto your first or second property. It could be really frustrating. It's like I'm kicking tires, and nothing's happening. And that's just what happens in these kind of markets. I mean, there's a lot of uncertainty in the market right now. There's a lot of confusion in the market right now. And so as investors, we have to look at the strategy, look at the options we have for strategies, and then be patient and methodically go through it. Having said that, you need to be prepared. So in other words, is your financial house in order? Have you got a good realtor? Have you got a good mortgage broker? Okay, let's go out looking and let's look at the options that we have, look at the region, et cetera. So we break it down. But the point is so many take this time off, but yet this is the time to be looking for deals.
Patrick, I think what you're saying there is very wise, because I know people are a little disheartened with the real estate market, and they feel like they're not making any progress, and they feel like, there's a lot of negative stuff out there. But I got to say, this is the very best market to be cutting your teeth in. This is the very best market to be out there trying, testing, tasting, and putting these things to the test, because and you don't have to go back very far, Patrick. It was only 2 years ago when people kept telling us, oh my God, I can't get any offers accepted. Oh my God, the realtors won't even call me back. Oh my God, the mortgage brokers won't even take my calls, because everybody was so damn busy. They wouldn't give anybody the time of day. Now, very different. I just looked at a property the other day, Patrick. Beautiful, 1.9 million, absolutely gorgeous property, commercial, huge plot of land, I think 3 acres, absolutely beautiful. But listen, I was talking, here's the tactics that were in play in the negotiation on the first meeting: price reduction, long closing, vendor take back, all in the first conversation. Totally open to financing part of the deposit, reducing the price, extending the closing so I had more time. I mean, all of this, that's not usually 2 years ago. You'd have to be submitting offers, sight unseen, 100% cash. It's crazy.
No,
and wow, this is such a good time for people.
Yeah. 100%. If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.